Welcome to our presentation on risk management in trading. Today, we will be discussing the importance of managing risks to drive profitability for hedge funds and trading desks. As you know, trading can be a risky business. However, with effective risk management techniques, these risks can be mitigated, leading to better returns and increased investor confidence. We will be exploring some of these techniques in detail later in the presentation. Market risk is the potential for losses due to changes in market conditions, such as fluctuations in prices or interest rates. Credit risk is the risk of loss due to a borrower's failure to repay a loan or meet other financial obligations. Liquidity risk is the risk of not being able to sell an investment quickly enough to avoid a loss. Operational risk is the risk of loss due to inadequate or failed internal processes, people, or systems. It is important for hedge funds and trading desks to understand these risks and their potential impact on profitability. By effectively managing these risks, they can minimize losses and drive profitability. One of the key techniques for managing risks in trading is diversification. This involves spreading investments across different asset classes, sectors, and geographical regions to reduce exposure to any one particular risk. Another technique is hedging, which involves taking a position in a financial instrument that is negatively correlated with an existing position. For example, if a trader holds a long position in a stock, they may hedge their risk by taking a short position in a related stock or index. Stop-loss orders are another important tool for managing risks. These orders automatically trigger a sale when a security reaches a certain price, limiting potential losses. Stop-loss orders can be particularly useful in volatile markets where sudden price movements can result in significant losses. Quantitative risk management is a systematic approach to measuring and managing risks in trading. It involves the use of statistical models and other quantitative tools to identify and analyze risks, as well as to develop strategies for mitigating them. One common quantitative technique used in risk management is value at risk (VAR) analysis. VAR is a statistical measure that estimates the maximum potential loss that a portfolio or trading desk could experience over a given time period, with a specified level of confidence. Other quantitative tools used in risk management include stress testing, scenario analysis, and Monte Carlo simulations. In 2008, during the financial crisis, a prominent hedge fund faced significant losses due to its exposure to subprime mortgages. To mitigate this risk, the fund implemented a sophisticated risk management strategy that involved using credit default swaps to hedge against potential losses. By carefully analyzing market data and using advanced quantitative techniques, the fund was able to identify the most effective hedging strategies. As a result, the fund not only avoided significant losses but also generated substantial profits during the crisis. In conclusion, effective risk management is crucial for hedge funds and trading desks to drive profitability and mitigate potential losses. By identifying and understanding common risks in trading, employing various risk management techniques, and utilizing quantitative risk management tools, firms can make informed decisions and minimize their exposure to risk. We have presented a case study of a successful risk management strategy employed by a hedge fund or trading desk, demonstrating the real-world application of these techniques. We encourage our audience to take action and implement these strategies in their own firms to achieve similar success. Like and subscribe, and we will catch you on the next one.